Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Ryan Huang. And we've got red on the screen as you would expect with all the talk around tariffs, stocks plummeting, and we've got the S&P 500 back into correction territory for its biggest one-day loss since 2020. And this all after President Donald Trump unveiled sweeping tariffs, raising the risk of a global trade war that could plunge the U.S. economy into a recession. So those concerns seeing the broad market index dropping 4.8%, settling at 5,397, posting its worst day since COVID-19 times. The Dow Jones Industrial Average tumbled 4%. That's 1,679 points down to 40,546. Its worst session since June 2020. The Nasdaq Composite was the biggest loser, plunging nearly 6%. And that is its biggest decline since March 2020. So a pretty broad sell-off. For more insights, we are joined by Yussef Gheriani. He is the Director of Investments and Operations at IHT Wealth Management. Yussef, thanks for joining us. Quite a busy day. How have you been doing?
Good morning. I think I've been better, but we're still here, and that's all right.
For sure. Markets have been better as well. So let's walk through your immediate takeaways so far. We've been seeing quite a broad sell-off. I suppose no surprises on that front.
No real surprises. I think perhaps a bit overdone when you consider the position of economic strength that we're entering this period from. But there's no two ways to cut it. Tariffs are a negative-sum game, and we think that this is being implemented fairly poorly.
Yeah, there is a lot of concern right now being raised with these tariffs coming in. The talk now about a recession is starting to grow. Are we likely to see one? What is your expectations of where this is going when it comes to growth?
We do think that there's a possibility, but we still have that as a less than 50% chance. The United States we're coming into this with 4% unemployment, healthy consumer balance sheets, and the United States produces more than 80% of what we consume, and we consume more than 80% of what we produce. We're a service-oriented economy, and while we're plugged into the global ecosystem, the average individual, goods are a small portion of what their actual expenditures are. So while this is painful and potentially inflationary, which is probably the bigger concern as far as a recession is concerned, we're still cautiously optimistic that the economy can handle this without a long, drawn-out grind lower.
All right, so we have odds of a recession going up. How about the odds of more rate cuts? We have seen some research houses upgrading their number of rate cuts for this year with the potential inflationary pressures coming through. Do you see that happening as well? More rate cuts on the table?
We are modeling, if you look at the expectations for rate cuts, and they're sitting at 3 or 4 rate cuts expected, I think what that really is either 0 rate cuts or 6 or 7, right? Essentially, people are saying there's going to be a severe and sharp kind of sell-off and an economic downturn, a serious one that requires rate cuts. Or if these tariffs come through and they're inflationary, the Fed probably needs to hold firm and stay where they're at until the degree to which they are inflationary becomes clear, right? Like we need clarity on that before the Fed can really start to try to support the economy.
Yeah, talking about clarity, we are looking at these tariffs, the 10% minimum kicking in on April the 5th, and then the higher tier on April the 9th. And this could actually potentially give some wiggle room or at least a window for a deal to be struck and I suppose these tariffs to be recalibrated to some extent. Do you see this as a potential catalyst for markets if this happens again? The potential for a deal to be struck, for example, with China to reduce its tariffs?
Whether it's the 9th or even further out, we think that everything is still on the table. There's not been great communication around how exactly these tariffs are going to be implemented and the degree to which they're negotiable. So from our seat, nothing is certain. We do believe that they need to get something figured out by midsummer such that they can proceed with the budget reconciliation or set out a budget for the government. We believe that that's the real deadline. Everything between now and then is pretty flexible. unfortunately.
Yeah. In the meantime, investors have been trying to look for safety, and it does look like some of these assets include bonds. We've seen them fall as low as 4% in the latest session. What's the playbook here for investors trying to find some harbour of sorts to get into a position to hedge their bets or investments?
Obviously, bonds are a safe place to hide during periods like this, but we prefer to think of these periods as opportunities to buy the highest quality names. It's rare that you get an opportunity to buy the people at the top of the stack, your Mag 6 kind of names at a discount. It doesn't happen often. And we would encourage people to look at high-quality companies with great balance sheets. Even if they have to defer investment during a time of uncertainty, they are the ones who have the flexibility to beat out the competition, and they can take advantage of downturns to increase their positional strength. Furthermore, they also have the capital if indeed they defer investment because they're uncertain about the rules of the game. That just means more money to either pay down debt or to execute share buybacks. So we actually like buying the highest quality companies in the S&P.
Yeah, that's interesting to point out. Last year was quite a record year for share buybacks. Now, with the correction and the slump in values, is this a potential tailwind for companies to continue that trend?
I think so. And I believe that at least maybe over the next couple of weeks, companies are going to sit on their hands. They're going to sit on cash for a little bit. But if there's any pullback in terms of investment, if people stop building large data centers, if people stop investing in new factories, well, they still have money coming in the door. And when that money comes in, they need to do something with it. And right now, the value of having a little bit of extra cash is higher, but the value of paying down debt and to buy back shares at attractive valuations, I think a lot of companies are going to take advantage of that if this downturn does persist.
All right, talking about taking advantage of a downturn, we are looking at small caps. The Russell 2000 index is the first major U.S. benchmark to enter bear market territory. So how do you feel about small caps right now? We've been hearing about the potential rotation from tech to small caps. Is this a great time to look at some bargains? What are you looking at here?
We're actually staying away from small caps, even though they are less exposed on a trade-weighted basis to tariffs. They have less, tariff-exposed business. But candidly, if you're still a small company after the last decade or two of growth and you have not been acquired and no one's come out to try to buy you, what does your company do? I don't want to say that they're all impaired, but as a space, we would encourage people to be careful. Companies that have not grown over the last 2 or 3 decades and are still small, there might be a reason for that. And we would prefer to see people take advantage of this opportunity to get into the larger companies at a discount as opposed to necessarily trying to chase small cap performance. There will be a time and a place for small caps when their earnings start to turn up, but that'll be visible in the earnings. And we think that you don't have to be early to that trade.
All right, perhaps better relative value when you look at the correction in the bigger names right now to look at. And we've been in conversation with Yussef Gheriani. He is the Director of Investments and Operations at IHT Wealth Management, helping us to break down the latest sell-off in the markets. Yussef, thanks as always for your time and insights. Great chatting with you.
Thank you so much. Have a great day.
All right, you too. Stay in Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.